All right, so Lemonade stock has been trading in a certain range for quite some time until recently, back in May, it had a bit of a jump, went as high as about 19 and a half bucks a share, and then has been since then sliding down until yesterday it hit a low about 14 and some dollars per share. And I feel like, sentiment in the stock, in people invested in the stock, in people holding the stock, is rather low. And I put out this tweet. It said, hey, sentiment in Lemonade land is bad right now. But the good news is that even though the stock price has fallen, the fundamentals are great. And I explained these fundamentals. OPEX is flat. IFP revenue, gross profit continue to climb. Losses are shrinking. Path to profitability is clearer, is ever clearer. The lifetime value to customer acquisition costs, LTV to CAC, is at least 4, if not 5 or higher by my calculations. They dominate renters and the growing pet market. They will become rate adequate in home and car in nearly all markets by the end of this year. Cross-selling and bundling should then greatly increase. And the CEO is very excited about innovations in their car product. They're going to be cash flow positive probably at the end of this year. Adjusted EBITDA positive and profitability are then soon after that, all on the horizon. And you're telling me the price decline has got you down. Personally, I'm thrilled to be adding at these prices because the risk to reward, in my mind, to be continue to add to my position has never been greater. And the purpose of this video, I thought, hey, maybe I could just go into all of these little details here that I outline, all of these points in more detail, give you guys a little bit more meat, a little bit more substance, and actually backing for each one of these statements. And then, hey, you decide for yourself. Nothing on this channel is personal financial advice. But then if that helps you, you're in your own conviction, that's great for you. But so let's dive into each one of these. First of all, operating expenses are flat while IFP, revenue, gross profit, continue to climb. So let's look at the first chart here. I have here in my Lemonade model, which is available to Patreon supporters. If you want to support the channel, you can check that out. But a history of their Lemonade's operating expenses over time. And you can see over the last, couple years, ever since maybe Q3, Q4 of 2021, operating expenses have been relatively flat with just a little bit of climbing. I had a tweet about this, and I mentioned how operating expenses have been basically flat since, somewhere in 2021. And I asked in Q4 2022 I asked Shai about cost cutting and operating leverage. He said, it's worth noting that our expense ratio today is built for scale, and we should be able to continue to grow very significantly without matching increasing costs. And that's what we're seeing. Very, very flat operating expenses. But if you look at operating expenses versus the IFP growth, you can see that even though your expenses have been flat, IFP has continued to soar. So we're talking about in this range, $85 million a quarter of total operating expenses, and now we're still at 99, a pretty small amount of growth. But since that time, we've had IFP was 350 million in that range, 380 million, and now we're at 794 million IFP. So this operating leverage will continue to play out. I believe will continue to play out with just small increases in the total expenses or in the operating expenses, and then top lines, and of course revenue, gross profit following that will really continue to soar. So next we'll talk about their lifetime value to CAC, customer acquisition cost, so LTV to CAC, which is at least 4, if not 5 or higher. And this was from one of their Lemonade letters. They said, in recent quarters we've seen LTV to CAC of 4 and higher. And how is LTV to CAC calculated? Well, if you're not familiar, I retweeted this tweet, and I'll link all these tweets that I'm walking through here in the description of this video, so you can flip through them or find them if you want to. But LTV to CAC, if you really want to understand this ratio, it's really, really important to understand this because the math doesn't lie. Like if they keep turning this crank and investing in the customer acquisition, and then they get a present value, a lifetime value that's in present value form, that it should pay off. That investment should pay off, even though it might, for insurance, it might take a little bit longer than we like, but it should pay off. So LTV to CAC, if you think about it, LTV is the present value of all future gross profits. So in the past, Lemonade management has said it's a 3-to-1. And it's roughly equal to customers' initial in-force premium, which is kind of doesn't have to necessarily be the case, just happens to be roughly that case. So if they spend $100 to acquire a pet customer who pays $300 a year in premium, that on average a cohort of the customers will work out to a present value of $300 for each customer, which is a very good return. So they get $300 in premium, but it's also saying the lifetime value of all those gross profits will be, in present value, will be $300. But I'm saying here, I think LTV to CAC is going to be better than 3-to-1, better than even 4-to-1, which then Lemonade in a quarter, I think after that said, hey, yeah, it is 4-to-1 already or above that. I think we'll go even higher than that, because if you look at, these are Q4's numbers, an example, $369 premium per customer. That was the average premium per customer, 77% at gross loss ratio, 87% annual dollar retention, which includes both churn and changing premium per customer due to bundling within the group of customers you're looking at. And I just use 4% time value of money. You could argue that maybe that should be higher, which would reduce it a little bit, but it's not a huge significant difference depending on what you plug in there. But gives an LTV of 519. So 519. And in Q4, I calculated they spent $110 on per customer on each customer acquisition cost. So 519 divided by 110 gets you 4.7. It's just really, really outstanding. And I think this will, as they bundle more and more products together, home and car are available in all markets, I think this number will go even higher. But 4.7, outstanding. And as I make the point here, it just takes time to see it in the results because the payback happens over many years, and it takes time to overcome all of their fixed operating expenses. But once they do, then the graph of EBITDA will change from the base it's forming now into a hockey stick. And in my model, I plotted out the LTV to CAC on a graph here, and you see if it was 4.7 in Q4, and then it was calculated 3.8 for Q1, so slightly lower, but the point here is that LTV to CAC is very dependent on the values you put into this equation, your premium per customer, your loss ratio, and your annual dollar retention. But if this can increase a little bit because there's more upselling, more bundling into higher products like home and car over time, and if your loss ratio, this is sort of the average loss ratio of 77%, or I think it was 79% in Q1, so slightly worse. But if you think about that as over the whole lifetime of a cohort of customers, this really should be a lower sort of lifetime loss ratio, which Lemonade talked about in their investor day a few years ago, which really could be more in the 60% sort of range, maybe even potentially lower than that over the lifetime of a cohort of customers. Then your LTV to CACs really get nutty. So these, in my mind, these are very conservative. You have done other videos on that where you kind of play around with this equation. And if you have a lower loss ratio in there, then for the lifetime, as a sort of lifetime loss ratio, then these numbers can easily be over 5, 6, 7, 8, even as high as 10 LTV to CAC. So get really, really, really positive results. But even in a conservative sense, we're still getting 3.8 and 4.7 numbers like that. Super, super positive. Next sentence we want to look at is that they dominate in the renters and growing pet market. So they dominate in the renters and growing pet market. I had a tweet about this, that Lemonade renters on average cost $14 a month versus $18 a month for the U.S. national average, though they still even offer rates as low as $5 a month. And they do this with a loss ratio of 47% in renters insurance as of Q2 2023, so a little bit outdated. If anything, the trajectory of this means maybe it's plateaued, or maybe it's even slightly better than those figures. But they significantly beat the U.S. average of $18 a month down to $14 a month for Lemonade renters insurance. And of course, they have amazing reviews for the product. There's even a blog here. They pulled this number from a Lemonade blog post here where they do a more thorough comparison for renters insurance and how much they are dominating there. Then I also had a post about pet insurance, how Lemonade is dominating in the pet insurance landscape or market there. So on average for cats, Lemonade is $14 a month versus $25 a month for the U.S. average. And dogs are $37 a month versus $66 a month for the U.S. average. And this is with a pet loss ratio of 77% and improving. Is still that same graph. If anything, my guess is it's gotten slightly better since then. And this is only possible, I point out here, because of their very efficient claims handling process. Again, here below here, I have a blog post where I pulled these values from pet health insurance costs for a dog, for example. And there's lots of comparisons here for dogs, for cats. You can go into that in more detail if you want to look through that again. But as I mentioned, this is only possible because of their very efficient claims handling process. So if you look at their Q1 letter, they talked about their loss adjustment expense, which is basically just the cost that insurer has to investigate and pay claims and make sure the claims aren't fraudulent, check into claims. So the more for a product like pet insurance, you have a high frequency of claims, you have lots of claims that are very small claims, well then your loss adjustment expense, I'm going to guess for a lot of people in the industry that offer pet insurance, it's tough to compete there very well because you have a lot of claims to make. So your loss adjustment expense, it says it is 10% for leading insurers with tens of billions in premium, but I'm going to guess for pet insurance lines across the board, my guess is they tend to be higher than that. But Lemonade's, even though they're relatively small, they're more heavy in the renters and pet insurance right now. Their loss adjustment expense ratio is 7.6%. And you can see they plot a graph of that ratio over time. And then they also show how their pet costs per claim, so their sort of internal administration of the claim has continued to press down that cost as they have more efficient systems, as they can more effectively use generative AI to handle claims as they come in and handle that back and forth with customers as is required. So this is really important though. This is a lot of Lemonade's secret sauce of why they can have such better prices. Like they could add $5 or $10-$20 to the dog pricing and have phenomenal loss ratios, but this way they pass on some of those benefits to the customer. They share some of those benefits with the customer, and then their customer acquisition costs will be lower, word of mouth will be higher, and they'll able to attract and funnel in and suck in those pet insurance customers, those renter insurance customers in these really unloved lines, and then of course grow with those customers over time. Which I mentioned is the next thing, is they will become rate adequate in home and car in nearly all markets by the end of this year. And Daniel mentioned this in my recent interview with him. Let's just have a listen.
I think we'll get out of it by the end of this year. There may be pockets that take a little bit longer. I don't want to say that every state will be fully rate adequate.
So once home and car are rate adequate in all markets, then they could actually more aggressively push these products, try and win current customers over. If you're in a market and you didn't even realize maybe they had home or car insurance in your own market, and even though maybe you have, pet insurance with them, there might be a reason why that you didn't realize it or didn't get a notification or email from Lemonade. It's because maybe they're not happy with where their pricing for home or car is at in that market, in your market yet. But over time, as rates are able to go increase a little bit and become adequate, then they're going to push these products out to you more aggressively and try and win your business and cross-sell these products to you. So then you're not just, spending, $200 on renter's insurance or pet insurance, but maybe you add your car and you add $1,500 of premium on top of the couple $100 of renters or pet insurance that you currently spend. So huge sort of opportunities for cross-selling and bundling should then greatly increase. Next sentence, the CEO is very excited by the innovations in their car product. This was a Q4 earnings call. I asked some really detailed questions, got some really detailed answers, which was great. One was about car rollout plans, and Daniel answered this and said, he did answer, a lot of details here, but one thing he mentioned was there's several exciting technology advancements that should help with cross-selling, and with even further refinement of our telemetry and the data science behind that those will be released in 2024 and will really enable us to accelerate car growth further in 2025. And I asked Daniel about this in my interview with him. He wasn't able to say anything further about what those tech advancements are, but exciting to see that he's very, very excited about the car product. That's very, very clear. And then finally, cash flow positive, adjusted EBITDA positive, and profitability are all on the horizon. So in their last letter for Q1 letter, they said they expect the net cash flow break even would occur during the first half of 2025. We're pleased to note that our expectations have improved, and we expect that to occur by year end 2024, such that by Q1 2025 we have to be generating positive net cash flow on a consistent basis. And then if you look at, again, going back to my Lemonade model, we're just pulling up a graph of adjusted EBITDA over a trailing 12-month time period. You can see the trend will really hit peak losses right when Lemonade said they would be hitting peak losses. And then since then, they've continued to trend in a positive direction. If you look at a graph of adjusted EBITDA to gross earned premium, you can see this trend also taking place, and then this projects out with my model into the future where things, are going to be headed here. But according to this, where I'm roughly projecting, is late 2025, early 2026, we could be hitting sort of a break-even point in adjusted EBITDA profitability. And so all this to say, hey, in my mind, they're really firing on all cylinders. All of these different reasons are super, super positive reasons for me to believe in the Lemonade thesis for the long term. Hey, and if the market wants to sell me shares at $14 a share, I'll happily buy them, as did the Lemonade CFO Tim Bixby. I tweeted this out earlier today, but he bought 20,000 shares on the open market at about $15.50 price per share, and $14.40 per share over June 13th and 14th. So, which is, again, really, really phenomenal. If the market wants to sell me Lemonade shares at $14 or $15 a share, I'm going to happily continue to buy shares as I'm able to. And let's just keep this on the down low, okay? Let's just keep building our conviction, but keep it on the down low, because for me, that's the ultimate way. That's what makes the ultimate sense. We get the ultimate risk to reward. The risk to reward, if you plotted that on the graph, it really skyrockets as they continue to execute on all these things, but the price of the stock continues to slide down into the $14 range. That's when you get the very best bang for your buck. And so many of us that have followed this story so closely can have more and more time to get more cash and accumulate more shares. I mean, as we each feel called to do it. Again, nothing on this channel's personal financial advice. I want to make that super, super clear. So totally up to you what you do with your own investments. But that's for me what I'm doing with my own investments and investment strategy right now. So let me know what you thought of all this down below in the comments. Feel free to join my Patreon if you want to check out that whole model for yourself. And thank you so much for watching. Remember, it's in the bag.